Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Wednesday, May 6th. We're seeing a mixed market right now. S&P's down a couple of points. NASDAQ a percent higher because seemingly it always is. And but we did see the S&P up about a percent early on today before giving back much of its gains. Let's look into that a little bit more. What we saw today was bond yields, treasury bond yields, tick a bit higher. That's normally a sign of economic strength. Markets like seeing treasury yields ticking a little higher, not necessarily egregiously so, but in this very low yield environment that we're seeing, a steepening yield curve and somewhat higher long-term rates could be perceived as a sign of economic strength. And I think that's what either traders or algorithms or the traders who program the algorithms saw in that move this morning. Until we kind of got to thinking about why are those rates higher. It's not really a big surprise. The Treasury needs to raise a lot of money, a lot of it. All these fiscal programs cost money that has to be borrowed somewhere, and that's the Treasury going out and borrowing that money. Remember also at the same time, the Federal Reserve has been cutting back its purchases of Treasury bonds, so it's really going to be up to the markets to absorb this supply. Also, we're seeing longer term rates go up more than shorter term rates because much of the money that's being raised is longer term, and we're seeing the 10 years, the 30 years, going up about 6 to 9 basis points, whereas we're barely seeing the shorter end of the curve moving at all. A lot of that has to do with the composition of the upcoming auctions. It seems to be weighted toward longer maturities, especially with the inclusion of a new 20-year bond. And so that's a lot of supply for the market to bear, supply and demand. More supply, lower prices. In bond terms, lower prices, higher yield. And that's, I think, what we're seeing now. And that's kind of why the broader market is a little less enthusiastic. The NASDAQ, again, remains essentially impervious. We've discussed many times about the 7 stocks that make up half the index. Those stocks remain higher. There remains money flowing into them. That sort of thing worries me a lot. Whenever you have very big concentration in a very narrow list of leaders, that ultimately doesn't end well. It's happened historically. You can go back to the 60s where you had the Nifty 50 stocks. You can go back to 1999-2000 period where you had the internet bubble. By the way, many of these same stocks were market leaders in the internet bubble, by the way. And so what you don't want to see now, I've yet to come up with a great term for them. There's the fangs or whatever. I think I'm going to start calling them Magnificent Seven because that's really what you're looking at now. And so when you get away from that, what's causing that? And as I've alluded to in the written pieces that I've published earlier this week, I believe a lot of that has to do with the massive amounts of liquidity as expressed by the Fed balance sheet. And the question that we have going forward is, are the markets responding to the absolute size of the Fed balance sheet, or are they responding to the rate of growth in the Fed balance sheet? That's really going to determine where we go, and it's really not something that we have enough evidence for right now. My gut tells me that it's the rate of change. Markets respond more at the margin to the rate, and rate of change is a marginal move. And so if we're starting to see some peaking of the expansion of the Fed balance sheet, that could start to put a lid on things. And again, when you have very narrow leadership, if everybody's piled into the same few names, if there's a catalyst toward people leaving, that ends, and it ends ugly. Now, the one thing to be cautious of there is the trend is your friend until it isn't, and there's really no telling when it isn't your friend here. The one tell might be if you started to see the Fed balance sheet actually decrease, but I think we're a long way from that. It would take a very broad set of economic strength, I think, for the Fed really to cut back purchases in a meaningful way to shrink the balance sheet. And I think that the gradual reopening is nice, but I think it's going to take a lot of work for the Fed to really hit the brakes rather than take their foot off the accelerator. And so that really becomes the question that we see now. Is it really a matter of Taking the Fed taking their foot off the accelerator? Is it a matter of supply from the Treasury? Is it a matter of the Fed tapping the brakes? This will all be resolved over the coming weeks. As I've mentioned various times, one thing to keep an eye on is the Fed balance sheets are released. Well, the composition of the Fed balance sheet and the size of that sort of thing are released Thursday afternoons, 4:30 Eastern time. We're back to looking at those again, and we'll keep you apprised when we see something. Take care.